Hello, Assalamu alaikum. This is Nafiz Al Tariq, and in this video I will talk about a complex investment strategy topic, asset allocation in a high inflation environment. During the periods of great moderation, the concept of inflation in the developed world investment strategy was quite absent, because this is the period of a decreased macroeconomic volatility and consistent period of low inflation. So the most popular asset allocation strategy for this period was 60-40 portfolio, which means 60% in equity and 40% in debt or fixed income asset class. The rationale behind the 60-40 portfolio was, during the risk on period when investors are mostly optimistic, stock prices and bond yields goes up, and since there is a negative relationship between the bond yield and the bond price, so when bond yield goes up, the market value of the bond goes down. During risk off period, when investors are very pessimistic, stock prices and bond yield goes down. Often what happens, the central bank tries to reduce the bond yield or reduce the interest in the economy to pump up the economy or pump up the stock market. And since there is a negative relationship between the bond price and the bond yield, since bond yield goes down, the bond portfolio goes up. So the mix of the stock and bond portfolio will balance the portfolio's risk and return. The fundamental assumption behind this traditional 60-40 asset allocation advice was that economy experiences consistent periods of low or moderate inflation. But this strategy may not work well during high inflationary environments. The reason is, in very high inflation scenario, both stocks and bonds can yield negative returns. So when inflation is increasing sharply, bond yields skyrocket alongside the higher inflation, and this leads to massive losses for bond portfolio. And the problem can be catastrophic for bond portfolio that has greater weight in high duration bonds. Very high inflation can be bad for stocks also. So the reason is, high inflation triggers high interest rates, and the correlation between stock and bond prices may turn from negative to positive during very high inflationary environment. Empirically, we have seen those periods of 1970s when we have seen that very high inflation and both stocks and bonds performed very badly. By 1982, the S&P 500 price earning ratio was 8, which is currently more than 30. However, many economists are arguing that current episode of high inflationary scenario is not different from the 1970s periods. Equities are hard when bond yields rise due to very high inflationary environment or the expectation that very high inflation will lead to greater monetary policy tightening. And not only that, in increasing interest rate scenarios, long duration assets are hurt most. For example, the tech stocks and startup companies. So one might ask, why are tech stocks, especially those are startup in nature, are high duration assets? So the concept of long duration is borrowed from fixed income asset classes. With respect to stocks, long duration assets are those whose dividends lie further in the future, making them more sensitive to higher discount rates. So the bigger question is, how can I protect or hedge my portfolio of bonds when equity market goes down sharply due to anticipated increase in interest rates? One can invest in inflation index bonds where it is available, or in short-term government bonds where yields reprice rapidly in response to higher inflation and higher interest rates. One can invest in gold and other precious metals whose prices tend to rise when inflation is higher. Gold is a very good hedge against geopolitical chaos. One can invest in real assets with a relatively limited supply, such as land, real estate and infrastructure. And the number 4, oil and energy, together with some other commodities. That can also be a good hedge against inflation, but the issue is very complex. In less sophisticated frontier markets, there is no instrument like inflation-linked bonds, and also in those markets there are no investable market for gold, commodities and energies. Real assets like land, buildings, infrastructure are not accessible to small investors because of the high unit value. So it can be a very precarious scenario in those markets. So what to do in such scenarios in those markets? So in those markets, one can focus on inflation hedged equities combined with companies that has high free cash flow generating ability. Those are the asset classes can do some hedge in very high inflation scenarios, along with real estate and other investable real assets. Thank you for watching the video. Stay safe. Thank you.